You know, whenever you hear people talking about an EU country with a crazy low corporate tax rate, chances are they're talking about Hungary. So today, we're going to dive in and see what the whole system is actually about. So, if you're an investor or you're running a business, you're always asking yourself this one question, right? Where in the EU can we operate most efficiently? Well, for a lot of people, that search ends in one particular country. And there it is, 9%. Hungary holds the title for the lowest flat corporate tax rate in the entire European Union. And really, that number is the foundation of their whole economic strategy to pull in global business. But what really tells the story is putting that 9% in context. I mean, look at this. It's not just a little bit lower. It completely undercuts major players like France, which is sitting at over 25%, and even its neighbors like Poland at 19%. That is a huge competitive edge. Okay, so let's start with that foundation, the 9% promise. This is the big, shiny number that gets all the attention and is the main reason why Hungary has become such a magnet for foreign companies. So, to be super clear, that 9% is what's called the corporate income tax, or CIT. It's charged on your company's taxable profit. And what's that? Well, it's basically your pre-tax profit from your accounting books, with a few tweaks based on Hungarian tax law. Pretty straightforward, right? But it's never just one number, is it? To really get the true cost of doing business, we have to look beyond that headline rate. It's time to peel back the next layer. So what else is in the mix? And this is probably the most important distinction to understand. You have the CIT we just talked about, but then there's also a local business tax, or LBT. Now here's the kicker. CIT is a tax on your profit, what's left over after all your costs. But the LBT, that's based on your net sales revenue, your total top-line income. That's a massive difference. So here are those other mandatory pieces. First, that local business tax, which can be up to 2% because it's set by the local city or town you're in. And then, tacked on top of that, there's a small 0.3% innovation contribution. Every business has to account for these. So, once you add the 9% CIT to the roughly 2% from the other local taxes, you're really looking at a more realistic effective tax rate of around 11%. Now, let's be honest, even at 11%, Hungary is still one of the most attractive places to be in all of Europe. But wait, the story doesn't stop there. In fact, this is where it gets really, really interesting. Because Hungary doesn't just give you a low rate and call it a day. No, it actually rewards specific kinds of investments with some pretty powerful incentives to drive that tax bill down even further. And just take a look at these. I mean, wow, a 200% deduction for R&D. You can get up to an 80% reduction in your corporate tax bill for big development projects. There are even cash grants and deductions for sponsoring things like movies and sports. These aren't just small tweaks. These are game changers. So here's the real takeaway. For companies that know how to play the game, that 9% isn't the floor. The real goal, with smart planning, is to leverage these incentives to push your final effective tax rate way, way below that famous headline number. Okay, of course, to get all these benefits, you have to play by the rules. And in Hungary, compliance isn't some boring afterthought. It's the core of the whole system, and they take it very, very seriously. And a perfect example of this is transfer pricing. The idea is simple. Any deal you do with a related company, say a subsidiary, has to be priced as if you were dealing with a total stranger. It requires a ton of documentation every year, and if you get it wrong, the penalties are steep. We're talking up to 13,000 euros per transaction. Ouch. It's also worth a quick mention of the value-added tax, or VAT. The standard rate, at 27%, is actually one of the highest in the EU. But, as you can see, that's not the whole story. They have much lower rates, 18% and even 5%, for essential things like food, medicine, and books. And when it comes to tax administration, everything is hyper-digital and efficient. It's basically a three-step dance. You report all your invoices in real time online, file everything through an electronic portal, and use a special secure gateway for any official communications. All right, for our final topic, we have to cover something incredibly important and time-sensitive. So if you're an American investor or have any U.S. ties, you are absolutely going to want to pay close attention to this. So first, what's a double taxation treaty? Well, it's exactly what it sounds like. It's a critical agreement that stops you from being taxed twice on this same dollar of profit, once in Hungary and then again back home. Hungary has these treaties with over 80 countries, so it's a standard vital protection. But, and this is a huge but, the treaty between the United States and Hungary was terminated last year. And, as you can see from this timeline, as of January 1st, 2024, that protection is gone. This isn't something that's coming in the future, it's the reality on the ground right now. And here's the bottom line. This is absolutely critical. Any money flowing between the US and Hungary, whether it's dividends, royalties, you name it, is now at serious risk of getting taxed in both countries. For any American company operating in Hungary, this changes the entire equation. You have to completely rethink your corporate structure. You know, this quote really nails it. Navigating the Hungarian tax system isn't just about finding the lowest number. It's about paying less, sure, but doing it the right way, and with the foresight to anticipate huge changes like this US treaty issue. So we'll leave you with this question. The tax landscape in Hungary is incredibly appealing, no doubt about it. But it's also complex, and it's changing. When you look at all these pieces together, from the low tax rate to these major international shifts, you have to ask, is your company's structure really prepared for this new reality?